Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at MP Materials.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, to really get into this, we have to look at a fundamental pivot that requires an entirely different framework than, what you might be used to looking at.
Right, exactly. I mean, imagine you're trying to completely rebuild a jet engine while you are actively flying at 30,000 feet.
Yeah, that sounds terrifying.
It is. You're swapping out parts, you're temporarily losing thrust, and you're just hoping the whole thing holds together mid-flight.
And that is exactly what MP Materials is attempting to do right now with their business model.
Yeah, they are taking this highly volatile, totally unpredictable rare earth mining operation, and they are basically tearing it down to the studs.
Right, to build a predictable, vertically integrated U.S. manufacturing powerhouse.
And so here is the core thesis we really need to view this entire analysis through today. We are no longer looking at a commodity miner.
No, not at all. We are looking at a federally protected infrastructure asset.
Yes, and framing it as an infrastructure asset is really the only way the current metrics make any kind of sense.
Exactly.
Yeah.
I mean, to understand the wealth building opportunity for your portfolio here, you have to look under the hood at the mechanical transition happening right now.
And their Q4 2025 earnings perfectly illustrate that turbulence of rebuilding the jet engine mid-flight, like we were just talking about.
Oh, absolutely. If you just pull up the headline numbers for that quarter, you might instinctively just hit the sell button.
Yeah, because their top-line revenue dropped a massive 13.6%, bringing them down to $52.69 million.
And, in almost any other sector, a 13% revenue contraction signals a business that is in deep, deep trouble.
Right. A drop like that on the top line usually triggers a massive institutional sell-off. So why didn't the floor just completely fall out from under the stock right then and there?
Well, because Wall Street actually looked past the top line for once, and they focused entirely on the bottom line execution.
Wait, so what did the bottom line actually look like?
Their adjusted earnings came in at 9 cents per share.
Okay, 9 cents.
Yeah, and the broad market consensus was pricing in just 2 cents. So they didn't just beat expectations, they completely crushed them by over 300%.
Oh, wow, that's a massive beat.
It is. And more importantly, that 9-cent profit completely reversed a 12-cent loss from the exact same period the previous year.
So they essentially intentionally shrank their raw revenue footprint just to drastically expand their profit margins.
Exactly. They traded volume for margin.
We need a better way to visualize this than just staring at balance sheet numbers,
Yeah, analogies definitely help here.
Let's use a coffee farmer analogy. So imagine a coffee farmer who temporarily loses revenue because they simply stop selling raw beans to wholesale buyers.
Right, they cut off their primary low-margin income stream.
Exactly. But they did it so they could build their own premium, high-margin coffee roastery.
That is a perfect way to look at it. The new roastery, in this case, is their magnetics segment.
And that segment is already producing, right?
Oh, yeah. It just generated $21.9 million as their Independence facility continues to ramp up its operations.
So the temporary pain of cutting off those raw material sales is already translating into highly engineered, higher margin components.
Right, and that underlying profitability is exactly why forward consensus estimates are pegging their full year 2026 earnings per share at 68 cents.
Wow, 68 cents. That is a really decisive return to structural profitability.
It really is.
But, transitioning from basic mining to advanced manufacturing is incredibly capital intensive.
Oh, absolutely. Building out specialized refinement facilities costs hundreds of millions of dollars.
Right. So how does a company pivot this aggressively, essentially constructing an entirely new downstream business without just burning through all their cash or spiraling into toxic debt?
Well, the balance sheet is arguably the most fascinating part of this entire turnaround story.
Okay, let's unpack that.
When a company undergoes a capex-heavy pivot, meaning, massive capital expenditures for physical buildings and equipment, you typically see their liquidity metrics just absolutely plummet.
Right, because they're spending all their cash on construction.
Exactly.
Yeah.
But their balance sheet is practically bulletproof right now. Let's look at the liquidity mechanics. They have a quick ratio of 6.67.
Wait, 6.67?
Yeah, and a current ratio of 7.24.
Okay, for anyone building their analytical toolkit right now, a ratio over 1 means a company can comfortably pay its short-term bills. A ratio over 7 is almost unheard of in heavy industrials.
It really is. I mean, it means they have more than 7 times the highly liquid assets required to cover their immediate liabilities.
That provides tremendous operational flexibility. They can absorb construction delays or, temporary supply chain shocks without facing a liquidity crisis.
Precisely. Furthermore, their debt-to-equity ratio sits at an incredibly conservative 0.47.
So they are not over-leveraged at all.
Not even slightly. But to understand why their balance sheet is so fortified, you really have to look at their economic moat.
The geographic monopoly, right?
Exactly. They operate the Mountain Pass facility, which is currently the only commercially viable rare earth extraction site in all of North America.
A total geographic monopoly, which is, I think, exactly where the U.S. government enters the chat.
Right on cue. The U.S. Department of Defense recognizes that relying on foreign adversaries for the materials that build our fighter jets and missile guidance systems is just an unacceptable national security risk.
So the DoD actually stepped in directly.
They did. They stepped in with a massive $400 million equity investment directly into MP Materials.
Wow. So they bolstered the company's cash position without forcing management to go to the open market and heavily dilute the existing shareholder.
Exactly. But the DoD went a step further. And this is really the fundamental anchor of the entire investment thesis here.
Okay, what did they do?
They established a $100 per kilogram, 10-year price floor for MP's NdPr products.
Let's pause right there. We throw the term NdPr around a lot when discussing advanced industrials, but for anyone who hasn't stared at a periodic table recently, what physically is that, and why does the Pentagon care so much about it?
So NdPr stands for neodymium and praseodymium.
Okay.
They are two highly specific rare earth elements that, when refined and combined, create the world's most powerful permanent magnets.
So we're talking about the magnets inside motors and generators.
Exactly. You literally cannot build a modern electric vehicle motor, a commercial wind turbine, or an advanced military drone without NdPr magnets. They're the invisible muscles powering the modern technological economy.
Right. So by establishing a $100 per kilogram price floor, the Pentagon is essentially telling MP Materials, look, we don't care if overseas competitors try to flood the market with cheap NdPr to bankrupt you.
Yeah.
We don't care if the global commodity market crashes entirely. For the next 10 years, you are mathematically guaranteed to never receive less than $100 a kilo.
Which completely changes the entire risk profile of the company.
It really does. It puts a hard floor on their worst-case scenario.
And it gets better. The DoD also guaranteed 100% offtake for MP's upcoming massive 10X facility.
So an offtake agreement basically means the government has legally promised to buy every single ounce of product that new plant can produce at that guaranteed minimum price.
Exactly. And that allows MP Materials to take that government contract to a bank and drastically lower their cost of capital, because the revenue is essentially sovereign-backed.
It's huge.
It is. And just to layer on the commercial demand, Apple recently signed a $500 million long-term agreement with MP to supply recycled magnets.
Right. Apple is integrating them into a closed-loop supply chain, which creates massive switching costs and basically prevents premier tech clients from easily jumping to a competitor.
Exactly. So with the fundamental downside heavily capped by Pentagon price floors and $500 million Apple contracts, we need to see how that is warping the technical setup on the daily charts.
Yeah, let's figure out where the smart money is actually positioning right now. What does the chart look like?
Well, the 12-month trailing performance has been explosive. The stock delivered a 150.6% return, running totally parabolic to hit a 52-week high of $100.25.
But it's cooled off since then, right?
Yeah. Since that peak, we've seen it pull back into the $60 to $65 range.
You know, when retail investors see a drop from 100 down to 60, including a recent 11.4% decline over just a 7-day period, the immediate instinct is to just assume the momentum is dead and the trend is reversing.
That's the emotional reaction, yes.
But how do we read the volume profile here against the moving averages?
You really have to separate that emotional retail panic from institutional consolidation. I mean, after a 150% run-up, an 11% pullback isn't a crash.
It's just a breather.
Exactly.
Yeah.
It is a necessary mechanism for the market to digest those gains. The stock is currently successfully testing the $60 to $62 zone as a new foundation of support.
And mechanically, it is bouncing right between the 50-day simple moving average, which is sitting at $56.94, and the 200-day simple moving average at $60.84.
Right. And when a stock compresses between those two major moving averages like that, it usually means institutions are stepping in to defend their cost basis.
They are essentially setting a technical floor that mirrors the fundamental price floor the DoD gave them.
That's a great way to put it. The convergence of those moving averages, combined with the way it is holding that $60 level, strongly suggests the broader bullish momentum remains fully intact.
So we are likely looking at the formation of a massive higher low setup on the macro chart.
I believe so, yes.
We also saw a sudden 16.2% surge in the stock price, accompanied by a massive spike in volume right after that Pentagon news broke.
Oh yeah, that was immediate.
That tells me algorithmic trading desks and large funds are highly responsive to these specific strategic catalysts.
Absolutely.
Now, we also have to acknowledge the Jim Cramer effect here.
Oh, of course.
He recently went on air, gave MP Materials his blessing, and basically said, quote, "I say yes," unquote. He called it the only basic materials stock he likes in that niche right now.
And retail investors undeniably follow those endorsements, which brings a flood of short-term liquidity.
But looking at the tape, retail flow is really just surface noise here, isn't it? The institutional accumulation is the actual ocean current driving the trend.
That's spot on. Retail volume creates those sudden, violent intraday spikes. But institutional accumulation is what builds long-term price floors and sustains multi-year trends.
Right.
With institutions clearly anchoring their positions and holding over 52% of the float, we really have to look at how Wall Street analysts and macro sentiment are attempting to model this transition.
Wall Street seems to be entirely buying into this whole infrastructure narrative.
They are. The prevailing sentiment is overwhelmingly bullish. Wedbush recently initiated coverage on the stock. They assigned it an outperform rating and slapped a $90 price target on it.
But what is truly notable to me is the specific terminology they used in their research note.
Oh, the label.
Yeah, they officially labeled MP Materials as America's rare earth national champion.
National champion. I mean, that isn't standard Wall Street financial jargon.
No, it's not. That is the language of sovereign industrial policy.
It really reflects the geopolitical reality of the asset. And the broader analyst consensus sort of to agree, with the 12-month average price target sitting right around $79.08.
That implies roughly a 36% upside from the recent $62 closing levels.
Exactly. And major firms like TD Securities and D.A. Davidson are maintaining really aggressive, strong buy ratings as well.
Let's pull on that national champion thread for a second, because the biggest macro tailwind here isn't just that they manufacture high-quality magnets, it is global geopolitics.
Yeah, the macro picture is impossible to ignore.
China is actively tightening their internal oversight and control over rare earth production and export quotas.
Right. Setting aside any political sentiment, the objective market reality is that China has historically monopolized the entire global supply chain for rare earth refining.
They completely cornered the market.
They did. And by tightening their export oversight, they are intentionally creating a massive supply bottleneck for Western aerospace, defense, and electric vehicle sectors.
Which forces the U.S. government's hand. It accelerates the absolute necessity of MP's domestic supply chain.
Precisely. The Pentagon simply cannot risk a scenario where a foreign adversary restricts the raw materials required to manufacture advanced weapon systems.
Okay, so the bull case is incredibly tight. We have a federally backed monopoly, massive geopolitical tailwinds forcing domestic adoption, and institutions holding the line.
It's a very strong setup.
But if you want to build lasting wealth, you have to actively seek out the flaws in the thesis.
Always.
Let's talk about insider selling, because if this is truly America's undisputed national champion and that massive 10x facility is going to send revenues into the stratosphere by 2028, why are the executives dumping shares?
That's their question.
The CEO sold roughly $16.5 million worth of stock in early 2026. And worse, the CFO sold $2.76 million, which reduced his direct personal holdings by over 26%.
Yeah, that looks bad on the surface.
When the chief financial officer offloads a quarter of his entire position, that sets off massive alarm bells for me.
It is a totally valid concern, and tracking insider flow is a crucial part of risk assessment. However, you really have to look at the legal mechanics of how those specific trades were executed.
Okay, what do you mean?
These were not open market, spur-of-the-moment panic sells. These transactions were executed under prearranged Roll 10b5-1 trading plans.
Right. Now, I know a 10b5-1 plan means the trades were scheduled by a computer algorithm months or even years in advance to avoid insider trading allegations. Executives use them for estate planning or paying massive tax bills.
Exactly. It's automated.
But let me push back on that. An executive can absolutely cancel a 10b5-1 plan before it executes.
That is true. They can.
If the CFO genuinely believed this upcoming 10x facility was going to triple the company's valuation, wouldn't he pick up the phone and pause the automated sell? The optics of a 26% reduction are just brutal for retail confidence.
You are right that optics matter, and a cancellation would have been a massive vote of confidence. However, you have to weigh the reality of personal concentration risk.
Meaning all his wealth is tied to one stock.
Right. If 90% of a CFO's net worth is tied up in a single, highly volatile asset undergoing a massive CapEx transition, responsible financial planning dictates diversifying, regardless of future upside.
I suppose that's fair. They're humans with mortgages and kids like anyone else.
Exactly. Furthermore, the bearish signal of that insider sale is heavily muted when you zoom out to the broader ownership structure.
Back to the institutions.
Right. As we noted, institutional ownership remains incredibly robust at over 52%. The smart money, the funds that have hundreds of analysts modeling out that 10x facility, are holding firm and accumulating.
Okay, fair point. Institutions aren't spooked by scheduled tax harvesting. But beyond the scheduled filings, what unconfirmed catalysts are floating around the market that could suddenly reprice the stock?
Well, given the massive U.S. push to secure strategic supply chains, there is persistent, very credible chatter that MP could announce further specialized offtake agreements.
Like the Apple deal.
Exactly. We already have the Apple blueprint, but rumors point to new bespoke agreements with major EV manufacturers and defense contractors who require highly customized NdPr magnet configurations.
That makes a lot of sense. Who else would they go to?
Exactly. Additionally, there's a developing story regarding a potential joint venture with Saudi Arabia's state mining company, Ma'aden.
Wait, what does a partnership in Saudi Arabia do for a company whose entire brand is being an American national champion?
It actually comes down to feedstocks. A joint venture could unlock alternative, lower-cost methods of extracting rare earths.
Oh, interesting.
Yeah, potentially from phosphate tailings, which completely bypasses traditional, highly expensive hard rock mining.
Oh, I see. So if MP can secure a cheaper alternative pipeline of raw material to feed into their highly profitable American refineries, it would expand their gross margins in a way that is absolutely not priced into current Wall Street models.
Precisely. It's a huge potential margin expander.
So for the active investor mapping out their portfolio over the next quarter, what are the concrete dates and execution milestones on the Catalyst calendar?
The immediate focal point is the upcoming earnings report, which is slated for the first week of May 2026.
Right around the corner.
Yeah, and following that massive bottom line surprise in Q4 of 2025, every analyst on the street is going to be hyper-focused on one specific metric, the magnetic segment margin.
Because they need to prove that the advanced refinery is actually scaling its profitability, not just burning cash.
Precisely. The market needs mathematical proof that the manufacturing transition is actively accelerating.
Makes sense.
Beyond the earnings call, you have to actively track the physical construction updates. You are monitoring the ongoing ramp-up of the Independence facility in Fort Worth, which has a 1,000-ton capacity.
But the true catalyst is any development update regarding the massive 10X facility, right?
Absolutely. That facility will boast a staggering 7,000-ton capacity.
7 times the output. That 10X facility is the actual engine of this entire wealth-building thesis.
It is the ultimate destination.
Yeah.
And hovering over all of these specific dates is the constant driving macro theme of onshoring.
Bringing manufacturing back to the U.S.
Right. As long as global supply chains remain fragile and geopolitical tensions run hot, that theme will continue to attract generalist investor inflows.
Meaning portfolio managers who don't even normally touch basic materials will buy MP Materials simply because they need exposure to the U.S. industrial independence narrative.
Exactly. It becomes a thematic play.
The narrative is definitely compelling. The technicals show a solid foundation. But, smart wealth building requires knowing exactly how a trade can blow up in your face.
Always. You have to know the downside.
Let's pivot to the bear case, and specifically the valuation. Because this is where the thesis looks incredibly precarious to me.
Let's hear it.
The stock is currently trading at a forward 12-month price-to-sales multiple of 22.93x.
Yep, that is steep.
The industry average for basic materials is just 1.44x. We are talking about a stock trading at an astronomical premium, holding a quantitative value score of F.
The valuation is undoubtedly the glaring red flag on the fundamental dashboard.
And you have to pair that multiple with their current profitability metrics. I mean, even factoring in the recent earnings beat, on a trailing 12-month basis, MP still carries a negative net margin of negative 38.26% and a negative return on equity of negative 4.28%.
Right. The trailing numbers still show the cost of the transition.
So this is where the risk becomes palpable. The stock has a high beta of 1.67, meaning it whipsaws much harder than the broader market.
It's volatile, absolutely.
At nearly 23 times sales, the market isn't just pricing in a successful pivot, it is pricing in absolute unblemished perfection.
It's priced for flawless execution.
Right. If they encounter a single major supply chain hiccup, if interest rates spike and raise their borrowing costs, or if they delay the commissioning of that 7,000-ton 10x facility by even 1 quarter, doesn't that 23x multiple just compress violently, like a house of cards? You don't get the benefit of the doubt at 23 times sales.
Well, if we were evaluating a normal mining company, you would be absolutely correct. A multiple like that would collapse at the very first mention of a construction delay.
So why won't it here?
Because this is exactly why you cannot value MP Materials using traditional commodity sector models.
How does the multiple survive a delay?
You have to factor in the Department of Defense's $100 per kilogram price floor.
Right, the sovereign guarantee.
That sovereign guarantee fundamentally alters the mathematical reality of their downside risk. When an analyst runs a discounted cash flow model, the worst-case scenario usually involves commodity prices crashing, completely wiping out revenue.
But the DoD agreement floors that worst-case scenario.
Exactly. Even if the 10x facility is delayed, even if global markets crash, their revenue baseline for their core product is locked in by the United States government.
So that effectively de-risks the massive capital expenditure.
It cements MP Materials not as a boom-or-bust commodity miner, but as a heavily insulated, predictable infrastructure asset. And infrastructure assets, especially federally protected ones, command massive valuation premiums.
Okay, when you reframe it like that, it really clicks. You aren't paying 23 times sales for a mining operation. You are paying a premium to own a piece of federally subsidized national security infrastructure.
Which brings us to the final verdict.
Let's do it.
When you weigh the clear execution risks and the stretched valuation against the overwhelming geopolitical tailwinds, the bulletproof balance sheet, and the government protections, this setup earns an 8 out of 10 bullish score.
Awesome. So if you are looking for the elevator pitch to summarize this entire analysis, MP Materials is successfully making a highly complex leap from a volatile raw material extractor to an insulated U.S. infrastructure powerhouse.
Well said.
And they are executing this pivot with the financial underwriting of the Pentagon and long-term commercial integration with Apple.
And regarding the target horizon for you, you need to align your expectations with the construction schedule.
So it's not a quick flip.
Not at all. This is a multi-year hold. It is a 2 to 3 year play, specifically designed to capture the full commissioning of the 10X facility in 2028.
Because once that facility is fully online and operating at maximum capacity, that is when you will see the margin explosion fully realized on the bottom line.
Exactly. That's the payoff event.
We are essentially watching a company fundamentally rewrite its own operational DNA, while the U.S. government quietly builds a financial fortress around it to ensure it survives the transition.
It's a fascinating structural shift.
It really is, which leaves us with a fascinating concept to ponder as you look at the rest of your portfolio today.
Ooh, I like where this is going.
If MP Materials proves that the government can successfully step in, underwrite, and protect domestic supply chains to break foreign monopolies, what other critical sectors are quietly becoming the next infrastructure gold rush?
That is the million-dollar question.
Look at the essential components powering your daily life. Where else is the government silently building a fortress?